So guys, I have come up with a course on capital budgeting and capital budgeting techniques. This is so very important in most of the industries. You go in any company, whatever projects are involved, capital budgeting techniques are going to be used over there. Especially for those projects which have a longer gestation period, means which take a longer period of time to get completed, capital budgeting techniques become so important over there. It's always very important to find out the viability of the project, whether you want to take up that project or not, or if you have got a choice between two projects, which one will you take up? Resources are limited and you need to use that in the most right way. And how can you do that? Once you start using capital budgeting techniques, you'll find out an answer to all these questions. You'll find out an answer to which project to take up, how to utilize the existing resource, which is actually a constant for you in the most effective and efficient way. This is what we are going to study over here. We'll start with the basic definition of capital budgeting, and after that, we will get into the techniques of capital budgeting. And while we are going to study the techniques of capital budgeting, we will be seeing them live. We'll be solving live examples to illustrate how to use particular capital budgeting techniques. Let us start with an introduction to capital budgeting. I would see you very soon just after this session. Now we are going to study capital budgeting. So capital budgeting is one topic which is considered to be very, very important while you're analyzing any project inside a company. The techniques that will be studied here are very much relevant while you're working inside corporate sector, while you're analyzing different projects, different investment alternatives, and you have to decide upon which investment decisions have to be taken. Things will become clear as you will start studying these techniques in details. These lectures are all inclusive and will cover all the details about capital budgeting. Now let us define capital budgeting. It is the process of determining the viability of a long-term investment on purchase or replacement of plant, property or equipment, new product line or other projects. So basically, once you're making a long-term investment, whether you are going to buy a plant, whether you're going to build up a plant, right? You're going to buy an equipment, you're going to buy a property, you're going to build up a property, anything, you're going to introduce a new product line, right? Any investment that you're going to do, which is kind of a long-term investment and involves a lot of capital, you know, and that is where you have to determine the viability of this long-term investment. Viability means whether it is going to give you the returns which you want or not. Like, if you go on investing money without even looking for returns, like in how many years it will give back the kind of a return that you're expecting, will you be able to recover the cost that you're incurring right now? All these things decide the viability of this long-term investment, and that is what is this process of determining the viability of all these long-term investments is known as capital budgeting. Now, investment is fixed and long-term, while future benefits are spread over several years. So what does this line means is that investment, you have to make a factory, you have to build up a new factory, so you have to invest it in one go, right? You're investing 2 crore in one go, but the benefits, that is the revenue, that is, that will be coming out from this factory will be spread over a number of years. It will not come in instantaneously. Some of it will come in the first year, then second year, third year, fourth year, and so on, right? So the future benefits are spread over several years, but the investment is fixed and it's going to be in one go, or it's going to be a long-term investment. Now, importance of capital budgeting. Why capital budgeting is so important? The first reason is the long-term implication of capital budgeting. Since most of the projects where there's a huge investment that is being involved or huge capital that is being involved, they are long-term projects. Long-term in the sense that to get the returns right, you have to wait for a long period of time, and that is where the the importance increases, right? Because there's a long-term implication of capital budgeting. So we'll see it over here. Since the impact of decision is long-term, so a wrong decision can prove to be disastrous. Now, you're investing a huge amount of money, but that return is going to come over a period of a long time. And if the decision is wrong, that is, the decision of investment is wrong, you are going to realize it after a long time, and that proves out to be very much disastrous for your company, for your organization. Right, because you have used a particular investment in some project which is not giving you return, which has acted as a failure. If you would have used the same capital for some other project, your company would have benefited from that. And that is why, capital budgeting becomes so important, because most of these investments are long term, and the results will come only after, a few years. And if after those number of years you realize that you have committed a mistake by investing here, you end up losing out investing on really good projects, because companies have, you know um, a fixed amount of capital which has to be invested, right? So since you have a fixed amount of capital that has to be invested, so you have to be very much selective in which project are you going to invest that capital, which gives you the maximum return possible. And that is why it becomes very important to use capital budgeting. On the other hand, if the investment in asset is not done, it would affect the competitive position of the firm. So on one hand, you have to be very much careful about investing in a particular project. But then you cannot decide of not investing, because if you don't invest in creating an asset or in an asset, you may miss out on the competition, right? Let us take an example that you are planning to launch some product in AI, and you have seen that the market trends are going are emerging in a way that the products which are based on AI will have a good market. But then that investment is risky because you don't know the returns, right? You're not clear about the returns, and then you abruptly decided of not to invest, and then some of your competitor decided to invest, and after 3 years the market became very good for some AI related products, and your competitor won. So it's a two-way street which is there. The first thing is that you have to be very much careful about investment in a particular project, so that you can realize returns, so that your cash doesn't stuck in projects which prove to be a failure in the long run. And the second thing is that you should not stop investing, right? So to solve both the things, to find out a compromise between both the things, to find out that equilibrium point, capital budgeting plays a very important role. The second importance is the large amount of funds are involved in capital budgeting. So wherever capital budgeting techniques are used, the funds are very high, right? Means you're investing a huge amount of fund for creating your capital assets. You are building up an entire plant. You are, buying a very big equipment. So the funds are very high. So, if the funds are very high, obviously the risk involved is very high. So you have to be very much, careful. You have to use the right techniques, and that is what, makes capital budgeting so important. The third thing is it's an irreversible decision in capital budgeting. So if the decision is wrong, that is returns not coming, or you could not find a market for the new product that you have launched, or returns are lesser than expected, the only way out will be to scrap the capital assets and incur heavy losses. So if you blindfoldedly invested in a project, right, and it's going to be, you have invested a lot of money in that, but if the decision proves out to be wrong, decision can be wrong in different ways, like you're not getting the expected returns, or there has been no returns at all, or if you have launched a new product line but you're not finding a market for that. All these ways goes on to say that your decision to invest in a particular project has proven to be wrong, and once that happens, you cannot recover your capital. The only way is to scrap all that capital assets, and you incur heavy losses. So just to avoid this, so that is why it becomes an irreversible decision, and that is why capital budgeting techniques become very important. So all these factors denote the huge amount of importance which capital budgeting has. The next importance is the risk and the uncertainty in capital budgeting. Now, the longer the period of project, greater may be the risk and uncertainty. Estimates about cost, revenue, and profit may not come true. That is so true. So if your project is very long, this means that your returns are going to come after a longer period of time from the time when you have done the investment. So if it's a longer period of time, you keep on investing money in that project for a longer period of time. This means that your money is not free for other projects, but you are not getting returns. You will get a return after a considerable amount of time. So you're waiting for the returns to come. So if the period of the project is large, obviously your risk and uncertainty become higher. Plus, you cannot be sure about the cost, revenue, and profit that may come true. And that is why it becomes very important to use the right capital budgeting techniques over here. The next thing is that whatever company you are, your ultimate goal is to maximize the worth of your equity shareholders. Or maybe I can say, if you want to use a wider term, you have to maximize the worth of all your stakeholders. And one of the most important stakeholders are your equity shareholders. So you have to maximize the worth. Maximize the worth means what? Whatever investment that they have done, you have to give them a return which is more than that investment. Right? So if I have done, 1 lakh rupees investment in your company, obviously I will be expecting, more than 1 lakh rupees from you. That is why I've done the investment. And that becomes one of the most important, you know, aim or target of any company, that is to maximize the worth of their equity shareholders. And how can you do that? If you start investing in the right projects, if you start investing in buying the right equipment, if you start investing in launching the right product line. And what will help you in doing that? Capital budgeting techniques. So that is where the importance of capital budgeting becomes really, really very important. Large and heavy investment. So since it's going to be large and heavy investment, so many of the companies will not have that much amount of capital in their kitty to invest. So they will go to the banks and take loans. And once you take loan, you have got an interest burden as well. So that is also has to be taken into account. And again, because of this reason, because there are a lot of finances that are being involved, using the right capital budgeting techniques become really, really very important. Now, what are the objectives of capital budgeting? So, from till now, whatever discussion we have done, I think you must be clear about, what is all, this capital budgeting thing is actually meant for. But, let us jot it down that, what are all the objectives. The first objective is to find out the most profitable capital expenditure and thereby deciding on which project to be selected. So you have got, one project, two project, three project, four project, and so on up to n projects. You'll apply capital budgeting techniques on each of the project and you will find out that which project is going to be more profitable and you're going to invest your money in that project, right? This is one objective of capital budgeting. Second thing is to know whether the replacement of an existing fixed asset gives more return than earlier. Let us take an example. You've got an equipment which is giving you, at its peak value, it's giving you a return or maybe, a kind of profit of 2,000 rupees per month. Now, there's a better equipment available inside the market as well, which has got a higher capacity. Now, the decision to replace this existing equipment with that better equipment, which is available inside the market, will depend on whether the return which this new equipment will generate, is more than what this existing equipment is generating. Considering the investment, the extra investment that you have to make in purchasing the new equipment. So in order to decide whether this existing equipment has to be replaced or not, again, capital budgeting plays a very important role. So this is the second objective. So the first objective is to, decide which project you should go on. Second is that, to decide on the replacement of an existing asset which is there. The third is to find the quantum of finance required for capital expenditure. So once, since, you have to invest on the projects, right? And you have decided, by way of that, this is the amount of funds that you have to invest. And since you know the amount of fund that is needed to be invested, you will decide the right finance that is required for that capital expenditure. Right finance means the right loan and the interest rates, right? Which bank to go, what kind of a loan that I should take, for what period I should take a loan, right? All these factors will be decided on the basis of the quantum, the capital expenditure that you have. So again, this becomes one of the objective of capital budgeting. Now projects are basically divided into two different categories. So there are two kinds of projects. One is the independent project and second is the mutually exclusive project. Independent project means if the cash flow of one project is unaffected by the acceptance of the other. Means the two projects are not in competition. So company has decided to invest in both the projects. They are not in competition. They become independent projects. Mutually exclusive project means that there's a competition between both the projects. Means company will either invest in this project or will invest in the other project. So if the company X has to invest in plant A in one location and plant B in the same location, it has to decide which one is going to be more beneficial. So these projects will become mutually exclusive, as cash flow of plant A will be affected if company decides to go with plant B. Right? So usually it's the case, right? I define it in this way. You've got this circle and you have got this circle. If the project is here and if the project is here, so I can say A and B project are independent project, but some project over here and some project over here. So what I can say is that AP are mutually exclusive project. Similarly, BQ are mutually exclusive project. Similarly, this P and Q are independent projects, or A and Q are independent projects. This is a particular location and this is a particular location. So this is how you define independent projects and mutually exclusive projects. Now, there are different techniques of capital budgeting, which we will be studying in very elaborate way with the help of a lot many examples. You will have a very clear understanding after going through all these examples. The first technique is the payback period method. The second one is the discounted payback period method. The third one is the net present value method. Fourth one is the internal rate of return method. And the fifth one is the profitability index method. Every method has got its own advantages and disadvantages. Plus, we will also see, which method many a times, professionals use a combination of methods as well. So, what did you study in the previous sessions? You studied about the importance of capital budgeting, the objectives that you want to attain by using different capital budgeting techniques. And then you also studied different kinds of projects. You classified those projects on different parameters, and you also studied the different kinds of projects which are there. And now it's the time to just dive into the different techniques which are used for capital budgeting. Aren't you excited enough? I am excited to take you through this journey of studying capital budgeting techniques. There are various techniques for capital budgeting. We are going to study the important ones which are used inside the industry. This is really going to help you become more productive. This is going to help you get your dream job and dream company. If you are a student, and if you're a working professional, will actually help you widen your domain, will actually help you become more productive employee for the company. The techniques that we are going to study: the payback period method, the discounted payback period method, NPV method, IRR method, an accounting rate of return method, and the last but not the least, profitability index method. We will study all these methods one by one, and once we study the method, we will do an example based on it, or maybe 2 or 3 examples based on that, so that you come to know about how do you actually implement those techniques on ground. Let us dive in, guys, and let us go into the first technique, that is your payback period method. So we will study all these methods in details. The first method is the payback period method. So payback period means in how much time can you actually recover the amount of investment that you have made. So let us suppose I have made an investment of 2 lakh 20,000 rupees, right? So investment means I have given from my pocket 20,000 rupees. So if I have made an investment of 20,000 rupees, I will indicate it with minus sign, means the cash has gone out of my pocket. In how much time can I recover this investment? So if company invests money, obviously it will need a return, because nothing is happening over charity over here. So if the company has invested 20,000 rupees, obviously it would want a return. Now what happens is that in the first year, you bought an equipment which was worth 20,000 rupees. In the first year, that equipment gives you a return of 2,000. In the second year, again, it gives a return of 2,000. Means it's giving you a revenue, it's giving you a sales of rupees 2,000. So I can say that, in 10 years, you can recover this entire cost. And this is what is defined by the payback period. If you have made an investment, in how much time can you actually recover that entire investment? In how much time can your cumulative cash flow becomes zero? In how much time can your net cash flow becomes zero? That is what defines the payback period. So it's given by the cash outlay, that is the investment that you have made, divided by the annual cash inflow, that is the cash which is coming in. You will understand this thing very elaborately with the help of examples that we are going to take. Now, there are two things which are there inside in case of this payback period method, is that the time value of money is not taken into account. This means that, for year, you know, the value of money is different over years, right? So if let us suppose, 2,000 is the value of money right now, after 2 years, it can increase or it can decrease as well. Right, so that time value is not taken into account. So let us suppose at the end of 2 years, it's generating 2,000 ka return. So what is its value present? That should have been taken into consideration. That is what is its value at present. But the payback period assumes that 2,000, the value will be 2,000 only. So it doesn't take into account the time value of money, right? Which becomes one of its disadvantages, because time value of money is so very important. The timing of cash flow is also not taken into account. So timing of cash flow means, it usually talks about the annual thing, right? Monthly thing. It doesn't talk about the exact time, like if it is annual, when it is in the month of March, April, when it is, right? So exact timing of cash flow is also not taken into account. So these two are considered to be disadvantages of using the payback period method. Now we'll be seeing some examples to understand payback period method in detail. Now, you know what is payback period method all about? So let us get into a live example. I'm very much excited to take you through some solved examples which will help you how to use payback period method. Let us get into there, guys. Let us see this example. So in this example, so there are two machines, machine X and machine Y. Machine X requires a capital of 18,000 US dollars, and it can reduce the annual labor cost by 3,000 US dollars. Means, if you buy this machine X, it's going to cost you 18,000 US dollars. And because you have invested this much amount, means invested means you have given out, means this is a cash outflow. So since you have given out, 18,000 rupees, 18,000 US dollars, what you're getting in return is a 3,000 US dollars reduction in labor cost. Reduction in labor cost means it can be considered to be a cash inflow, right? It can be considered to be a cash inflow. Why? If you are reducing cost, it is, right, kind of a saving, can be considered to be an inflow, right? So if you're investing 18,000 US dollars, you're getting a cash inflow, annual cash inflow of 3,000 US dollars. So in how much time can you recover this 18,000? In how much time can you recover this 18,000? So that will give you the payback period for machine X. So can I say that I can recover this 18,000 this 18,000 divided by the annual returns that I'm getting, annual inflow that I'm getting, that will come out to be 6 years. So in 6 years, I can recover the entire 18,000 US dollars. Similarly, in case of Y, machine Y requires a capital expenditure of 15,000 US dollars, and the same gives you a reduction in the annual labor cost of 3,000 US dollars. Means there is a cash inflow of 3,000 US dollars on the similar grounds. So in how much time can you recover this cost of Y? That will be given by this 15,000, that is J7, divided by this 3,000, that is J9. That comes out to be 5 years. So as I can see from here, that the payback period of Y is less than that of X. Means in case of Y, you will be able to recover your cost in a lesser period of time. So Y will be better. So Y should be selected. So which machine is the best? Y is the best. Y will be better in this case. So this is how, by using the payback period method, you can decide that which machine should be purchased. and an investment of amount should be done. Now let us take another example to explain this concept of payback period. So in this case, Ram has invested 3 lakh rupees and expects a return of 20,000 per month in the first year and 15,000 per month in the second year. Find out the payback period. So payback period is basically the period in which you can recover your cash outflows, means you can recover your investment, right? So in year 0, means in the beginning, Ram has invested 3 lakh rupees, means there is a cash outflow, means cash has gone out, and cash outflow is denoted by a negative sign. So there is a cash outflow of 3 lakh rupees, right? So there is a cash outflow of 3 lakh, right? Now, in year 1, he is expecting a return of 20,000 per month. So in a particular year, what will be his returns? That will be 20,000 into 12. That is equals to 2,40,000, and that will be in plus sign because that's a return, means it's a cash inflow. Similarly, in year 2, he is expecting a return of 15,000 rupees per month. So that will come out to be 15,000 into 12. So that will again be positive 1,80,000 because it's a return. So it's a cash inflow. Now, when you recover your entire cash outflow, obviously your net cash flow will be 0, right? That is, your cumulative cash flow will be 0. So basically, in other way around, you can also say that payback period is the time in which your net cash flows become 0, right? In which your net cash flow becomes 0. So at the, in the beginning, what will be the cumulative cash flow? That will be equals to minus 3 lakh. At the end of year 1, what will be your net cash flow? This will be the first one plus this thing that you have generated. So this will come out to be minus 60,000. And by the end of year 2, the net cash flow will be this one, that is minus 60,000 plus 1,80,000 that you have generated in this year. So that comes out to be positive of 1,20,000. So one thing which we can see is that somewhere between year 1 and year 2, the cash flow has got, the net cash flow, the cumulative cash flow has got 0. So the payback period will be anywhere between 1 year or 2 years. So it will be 1 point something year. So 1 year is something which we are completely sure. Now it will be somewhere between 1 to 2 years, and we have to find out the decimal value. Now, in year 2, you are generating a positive cash flow, that is cash inflow of 1,80,000, which has to compromise for minus 60,000 ka cash flow, which is already there. So can I say that the period in which you can recover this thing will be equals to minus of this thing So in this case, it can be calculated as minus of, this 60,000 cash outflow that has to be, this is 60,000, that is the cash outflow that has to be compromised. And, in the second year, you're generating 1,80,000. So that divided by 1,80,000. So 0.33 years, out of the one complete year in which you are generating 1,80,000 will be used to actually compromise for this 60,000 ka cash outflow. That is why your net comes out to be 1,20,000. So what I can say is that the net payback period will be equals to this 1 year plus this. That is 1.33 year. And if you want it in months, you have to just multiply it with 12. So that will come out to be 16 months. So 16 months will come out to be your payback period in this case. So here we are going to see another example in which we have to calculate the payback period. So the question is, an investment of 2 lakh rupees will generate the following cash inflows. So initially you have invested 2 lakh rupees, so it's being denoted as a cash outflow. And as you know, cash outflow is always denoted in negative because it's the money which is going out. Investment is a cash outflow. Now from year 1 to year 6, you have got these following inflows which have been given to you. In year 1, you got an inflow of 70,000. In year 2, you got an inflow of 60,000. In year 3, it's 55,000. Year 4, it's 40,000. Year 5, it's 30,000. And year 6, it's 25,000. Now, what is payback period? The period in which you can take out all your investment, right? Investment is of 2 lakh rupees, or the period in which the cumulative cash flow or the net cash flow becomes zero. That will be considered to be your payback period. So can I say that in the beginning, the cumulative cash flow will be equals to C5, that is 2 lakh, that is minus 2 lakh. At the end of year 1, the cumulative cash flow will be minus 2 lakh plus the cash inflow that you have generated in year 1. So this will come out to be minus 1,30,000. Similarly, in year 2, this will be minus 1,30,000 plus the cash inflow that you have generated in that year. In year 3, it will be the cumulative cash flow previously plus the cash inflow that you have generated in that year. And the same thing will be done for year 4 as well. Similarly for year 5 and similarly for year 6. So these are all the cumulative cash flow at the end of particular years. So if you see this cumulative cash flow, what you find out is that the cumulative cash flow has got zero between year 3 and year 4. So in between, somewhere between year 3 and year 4 is your cash flow, the cumulative cash flow has become zero. So one thing is for sure that I know that it will be more than 3 years. So I write 3 years over here. Now I have to find that after how much time after the 3rd year and before 4th year, your cumulative cash flow becomes zero. So at the end of 3 years, we have got 15,000 rupees which have to be consumed. And in year 4, you have generated 40,000. So what will be the time taken to consume this 15,000? That will be minus 15,000 divided by 40,000 that you have generated in complete year 4. And that will give you 0.375 years. So your payback period will become 3 plus 0.375, and that will come out to be 3.375 years. And if you want to calculate it in months, you just have to multiply this thing with 12. So that will come out to be 40.5 months, means 40 months and then half month. So this is the time in which you can, your cumulative cash flow will become zero, and your cumulative cash flow becomes zero means this is the payback period. So you can recover all your investment of 2 lakh rupees in 40.5 months. Now we will see another question based on the payback period method. So in this question, the question is, due to increased demand, company X has decided to purchase a new equipment to increase production and revenue. So in order to increase production and revenue, the company X has decided to purchase a new equipment. Useful life of the equipment is 10 years. And the company's maximum desired payback period is 4 years. Means within 4 years, what the company wants is that whatever it is actually investing should be recovered. Cash inflow and outflow are as follows. So if you see here, this is the data that has been given to us, right? This is the data that has been given to us. And in this case, the initial cost of equipment, that is, the amount of money which the company invested to buy that equipment is 37,500 rupees. And then, annually what is happening is that you have got some cash inflow coming annually as sales, and that is equals to 75,000. But then annually there are some expenses as well, which will be considered as cash outflow. One of those expenses is cost of ingredients, that is cost of raw material, you may also say, that is 45,000. Salary expenses, the money that you have to give to your employees, that is coming out to be 13,500. Maintenance expenses is coming out to be 1,500. Then there are also non-cash expenses in the form of depreciation expense, that is given to us as 5,000 rupees. Now remember this thing, that in case of payback period method, we only consider cash expenses. Depreciation is considered to be non-cash expense because actually there is no cash coming in or going out, but this thing is taking into consideration that the value of the equipment is going to go down. We will study this in detail in another videos, but for right now
in case of the payback period, we don't have to consider non-cash expense, and depreciation expense is one of the non-cash expense which is there. So if you see here in year 0, that is in the beginning, the company invested 37,500 rupees to buy that equipment. So it's a cash outflow. So it will be placed in with minus sign, minus 37,500. And if you talk about the cumulative cash flow, obviously this will be equals to this itself, that is minus 37,500. Now year 1, there is going to be some cash flow. Now year 1, if you see, there's 75,000 in every year. Actually, this is the case that in every year there's a cash inflow of 75,000, but there are cash outflows of 45,000, 13,500 and 1,500. So can I say that the net cash inflow will be this 75,000 minus 45,000 minus 13,500 minus 1,500, and that comes out to be 15,000. So 15,000 is your net cash inflow. Similarly, for year 2, it will be 15,000 only. Similarly, for year 3, it will be again 15,000. And for year 4 also, it will again be 15,000. And for year 5, it will also be 15,000. Because every year, you've got a cash inflow in the form of sales, and then there are this much cash outflow. So the net will be the cash inflow minus the net cash outflow. Now the cumulative cash flow by the end of first year will be this much plus 15,000 cash inflow that you have generated. This will come out to be 22,500 with a negative sign. By the end of year 2, it will be this much plus the 15,000 again which you have generated. So minus 7,500. At the end of year 3, this much plus the 15,000 that you have generated. At the end of year 4, the previous one plus the 15,000 that you have generated. And at the end of year 5, this much plus the 15,000 that you have generated. Now, if you see the cumulative cash flow somewhere between year 2 and year 3, is that I'm going, your cumulative cash flow is going to be 0. So that will be your payback period. So one thing is for sure, I know that it's going to be 2 years. Now, how much more than 2 years and before 3 years is the cash flow, is the cumulative cash flow going to be 0? So again, we have to compensate for this 7,500 in the third year. And in third year, you are generating a complete cash inflow of 15,000. So this will be divided by 15,000. Now, why I'm doing minus in front of it is that I want it to be positive number, right? So if I press enter, I get 0.5. So this means that my net payback period is going to be 2 plus 0.5. That is going to be 2.5 years. 2.5 years in months, if you convert it, this will be 30 months. So 30 months is my payback period. And since 2.5 years is less than the maximum desired payback period of the company, that is 4 years. So that is why this decision will be taken. This decision means the decision to buy the equipment will be taken. So this is how, by using the payback period method, you can actually decide on whether you have to buy that equipment or not, or you have to take up this project or not.
Congratulations! You have completed the first technique of capital budgeting. That is the payback period method. It was nice to know this, and it has been used inside the industry for a long period of time. Let us go into the second technique. The second technique says discounted payback period method. It takes into consideration the time value of money. The time value of money. Want to know what is it? Let us get into the session. So it starts with introducing you to discounted payback period method, and after that, I will be back soon to introduce you to some solved examples which will help you how to apply discounted payback period method in details. See you guys.
So as we have already studied inside the payback period method, that there were two things which were not taken into consideration while calculating the payback period, right? So what was the first thing that was not taken into consideration? First thing was the time value of money was not taken into consideration. That is, the time value of money was not taken into consideration. And second is the timing of cash flow was also not taken into consideration, right? So these two things are not taken into consideration. And you understand, what do you mean by time value of money? Means that if you have got, if you have got 2 rupees at present, right? If you have got 2 rupees at present, right, its value after 2 years or 3 years, or any period of time, will be different, right? Means you can think of it in such a way, like if you can buy one toffee right now with 2 rupees, after 2 years, maybe for buying the same one toffee, you may be requiring 2.5 rupees. So what has happened is that this 2.5 rupees, which is actually the future value of this 2 rupee, because you are buying the same value. What is your value? That is one toffee, but now you're buying at a higher price, right? Means this 2.5 is the future value of 2 rupees. Means if you know for buying the same value, you have to pay an extra amount. So this means that the value of money has actually decreased. Did you get that point? Because for buying is the same item, you're actually going to pay a higher amount. This means the value of money has actually decreased in the future, right? So what I want is that I want this future value to be converted in the present value, because I am doing the calculation right now. So if I am doing the calculation right now, I want all the values to be converted into its present format, right? So I have to divide this 2.5 by some X amount so that it comes out to be 2. And this X amount is called a discounting factor, right? Or you can either say it, you divide it by X, or you have to multiply it by some Y amount. And what is Y? Y is nothing but 1 by X. And this Y is called the discounting factor. And once you multiply it with Y, what you will get is 2. So what is meant over here is that you have to convert all the future values to the present value, because you are doing the calculation right now. So that conversion becomes so very important. Right? Why? Because the value of money changes over time. You want all the value of money at a particular time. You want all the values converted to the present time. And for that, you use a discounting factor. And that discounting factor is taken into consideration while you are converting any future value into a present value, or any present value into a future value, right? So that is why we come to a method of capital budgeting, which is called discounted payback period method. This method takes into consideration the time value of money. This method takes into consideration the time value of money. So in this case, the discounted cash inflow, that is the present value of a future value, will be equals to the future value, that is the actual cash inflow at that time, that is the future value, multiplied by this factor, which is 1 by 1 plus I to the power n, that is 1 by 1 plus I to the power of n, where I is called the discount rate, is also called rate of return, and n is the number of years, number of period of years, this future value is ahead of the present value. So let us suppose, you want to calculate everything at the present and it's at the third year. So 1 2, so this is one period, second period, third period. So the value of n will be equals to 3. The value of n will be equals to 3. Now, what is I? I is called a discount rate. It's basically also called a rate of return. Now, how to understand I is that if, let us suppose, instead of investing that money in that particular project, I would have invested that money in a bank. Maybe, I would have created a fixed deposit, recurring deposit, or maybe, put it as a savings in my bank. What is the kind of interest that I would have earned? And that is the interest that I'm actually losing out over here. That is the interest that I'm actually losing out over here. So this is how you can understand I. I is called the discount rate or the rate of return. So we will use, this method. We will see it with the help of an example so that you will well understand how this discounted payback period method works in case of capital budgeting.
Okay, so you now know what is discounted period method all about. You know the concept pretty well. It's the time to go on the ground and let's see how do we implement it. Let us take some solved examples.
So here we are going to take an example to explain capital budgeting using discounted payback period method. So the question is, the initial investment of INR 23,24,000 is expected to generate 6 lakh rupees per year for 6 years. Find the discounted payback period if the discount rate is 11%. So again, payback period, discounted payback period, where the cumulative cash flow will be equals to 0. Means your cash inflow should be equals to cash outflow. In case of the just payback period method, we were not, taking the time value of money into consideration, but in this method, we'll be taking up the time value of money into consideration as well. Let us see how it goes. So initially, you have got an investment of 23,24,000 rupees over here. So I have mentioned it with a negative sign. Now, in the subsequent years, likewise for year 1, you generate 6 lakh rupees of cash flow. That's your inflow because you're generating a return. And that happens for 6 years. That is for year 1, 2, 3, 4, 5, and 6. You generate 6 lakh rupees and that becomes your cash inflow. So what you want basically is that you are analyzing this entire thing at year 0. Means in the beginning, you are actually analyzing it. So you want all the cash inflow or outflow to be converted into a value which should be representative of year 0. That is in the beginning. So if you talk about the initial cash flow of 23,24,000, it's being incurred in the beginning itself. So the value will remain the same. So that is why in the beginning, the discount factor is taken to be 1. So what will be the present value? The present value will be discount factor multiplied by the cash flow which is there. Now, in case of year 1, means after 1 year, what will be the discount factor? The discount factor is given by 1 divided by 1 plus I. I is the discount rate. And what is it? 11%. So 11% will be written as 0.11. Bracket closed. To the power of 1. Why? Because the period is 1. 0 to 1. The period is 1. So that will be the discounting factor and that comes out to be 0.9009. Similarly for year 2, if I have to say, or else I will just copy paste this formula over here. So Control C, Control V. Once you do Control V, it pastes the formula. So if you see here, we just need to change one thing, that is this 1 will become 2. So the discounting factor will become 0.8116. Again, I will copy it and I will paste it, Control C and Control V. I have to change one, we have to make one change, that is 2 will become 3. So this will become the discounting factor. We are going to do the same thing over here as well. This 3 will become 4. Now for this 4 will become 5 because there are 5 periods now. And for this 4 will become 6 because there are 6 periods now. So this way, you can calculate the discounting factor all around. Right? Even this 1, if you write it in terms of this thing, right? 1 divided by 1 plus 0.11 to the power of 0 it will be. Why? Because there is no period over here because it's in the beginning itself. So it will again come out to be 1 itself. Right? So this is how I calculated the discounting factor, and the present value of cash flow will be the cash flow which is there into the discounting factor which is there. And this is why we multiplied, C5 with B5. Now there's a plus sign which comes over here. If you just double click it, what you can do is that you can you can, replicate this formula. That is, this 540 is nothing but 6 lakh multiplied with 0.990, as you can see over here inside the formula, right? Similarly, this multiplication, right? So the same formula gets replicated. Now, cumulative cash flow. So cumulative cash flow, in the beginning it will be this thing only. Now after this, this thing plus with 5,40,000 that you have generated in the subsequent year. Next it will be this thing, plus 4,86,000 something which you have generated in the next year. Similarly, you will keep on doing this. This will become 85,000 now. So we calculated the cumulative cash flow at the end of each of the period. Like initially it was 23,24,000, then it kept on decreasing, and ultimately it was 2,14,322 rupees. Now, so we have to consider this cash flow into account. So where is the net cash flow, that is cumulative cash flow, becoming zero? Somewhere between year 5 and year 6 it is becoming zero. So one thing is for sure, that it will be more than 5 years, and it is going to be less than 6 years. But how much more than 5 years? We already know, in case of how we used to do in case of the payback period method, is minus of this divided by how much positive cash flow that you have generated in this particular year. This will give you how many years it will be more than 5. So if you have to find out the total, this will be 5 plus 0.331879 years. If you have to find it out in months, you just have to multiply it with 12. So this will come out to be 63 months, 63.98 months, somewhere around 64 months, right? And this is less than 6 years, right? So the project will be accepted. Why? Because the desired payback period is of 6 years. So the project will be accepted. So as you see over here, there's no much difference in the way we actually solve it for the payback period method and for the discounted payback period method. The only difference is that you take the present value of cash flow into account while using this method. So kindly practice all these questions at least for 2 to 3 times, so as to be clear with all the concepts.
Congratulations! You have completed discounted payback period method as well. You are not an expert, and you can use both the techniques that you have learned to solve capital budgeting problems. You have now become a little bit more productive for the company now, and now you have also widened your horizon. You are more closer to your dream job. And the next method that's going to make you more expert in this capital budgeting is the NPV method. NPV, net present value method. What is it all about? And how can we actually apply it on some live project? Aren't you interested? Let us go deep into that and let us study what is NPV method all about.
Now the next method that we are going to study is the net present value method. This is a very important technique inside capital budgeting techniques that we will study here. The first thing is that the net present value method, also called the NPV method, it takes care of the time value of money. And we already know what you mean by time value of money. So, I just took an example in the previous video, is that let us suppose you are buying a toffee and that is costing you 2 rupees. But after 2 years, you're buying the same toffee, but it's costing you 2.2 rupees. That means that for buying the same value, that is one toffee, you're going to pay more amount. This means the money has lost its value, right? The money has lost its value. So actually, the value of 2.2 rupees is still 2 rupees only. So if you are considering this 2.2 rupees for a calculation, that calculation won't be good. So we need to convert it to the present value. Present value means at present, what is it? So we have to divide it by some factor or multiply it with some factor which converts it back to its original, that is present value, and that factor is known as the discounting factor. And this is what we studied inside the previous class as well, previous video as well. So that is why it says that NPV method takes into consideration, the time value of money, which is very, very important. Now this method takes, two things into consideration. So it takes two inputs into consideration. So the first one is the net cash flow in successive periods from the project, and a targeted ROR, that is the rate of return or discounting factor. So there are two inputs which will be required, like, in whatever period, what are all the cash flows which are there. And then you also require a discounting factor, also known as the rate of return. And this discounting factor will be used to discount the future cash flows to the present value. So in order to find out the present value of all the future cash flows, we'll be using this discounting factor. This ROR or rate of return is used to discount the net cash flows, as I told you just now. WACC is the most commonly used ROR. WACC is weighted average cost of capital. So for now, you can just imagine it to be, if you would have invested the same amount in a bank, right? The interest that the bank would have given it to you, that is your cost of capital, right? Cost of capital means what, right? If you would have invested it in some other thing, right, what is the interest that you have got? This is that is the cost that you are actually incurring by investing this particular amount, not in bank but in this project, right? So that rate of return is considered to be this interest, and this is called WACC as well. Just for understanding, I'm telling you, this is not exactly what it is, bank interest rate, but this is, you can actually relate it to this to understand it. Right, so WACC is the weighted average cost of capital, which is, most commonly used as an ROR, that is rate of return. Now, how to take decisions on projects? So if NPV, so we will be discussing about two things. First will be the independent projects that you have, and the second one will be the mutually exclusive project. So independent project means the cash flow of one project doesn't depend on the acceptance or rejection of the other project, right? But in case of mutually exclusive projects, they do depend, right? So if you remember, we discussed these two sets. So P, Q, A and B. So A and B are mutually exclusive project, but A and Q are independent. B and P are independent. Similarly, B and Q are independent, but P and Q are mutually exclusive, because P and Q and A and B are located in completely different locations, completely different atmosphere, right? So that is why they are considered to be independent projects. So in case of independent projects, if NPV is greater than 0, accept that project. If NPV is equals to 0, then you are in a dilemma. So you have to use some other factors also, to decide whether to accept or to reject the project. And if NPV is less than 0, reject the project. Now in case of mutually exclusive projects, right, you calculate the NPV of all the projects and accept that project which is having a higher NPV. So if you have got 1, 2, 3 projects, out of which you have to do one thing, so you calculate the NPV for NPV2, NPV1, NPV3. So you calculate the NPV of all the three projects, and whichever comes out to be higher, you have to accept that project. You can go ahead with that particular project.
So guys, now you know what is NPV method all about. You know the definition, and you know how is it actually different from the previous two techniques that you have studied so far. We will now go and take some live examples, and we will use NPV method to solve those capital budgeting problems. Let us get into that and let us enjoy solving this.
Now let us see an example where we have to calculate the NPV of the project. So the question goes like this, that calculate NPV of a project which requires an initial investment of 2,43,000 and is expected to generate a cash inflow of 50,000 rupees each month for 12 months. Now assume the salvage value to be 0 and the target rate of return to be 12% per annum. So 12% per annum but it's given like 50,000 rupees per month. So if I've got a rate of return of 12% per annum, if we convert that into month, so I just have to divide this interest rate by 12, and this will give me per month. So remember, to convert, if the cash inflow is given per month, you have to convert the rate of interest from per annum to per month, and that can be that can be done by dividing it by 12. So what it is saying is that in the beginning, like I can say month, let us denote it by month 0. So in the beginning, right, there is a cash outflow, that is you are investing. So we have denoted it with minus 2,43,000, and then in each of these 12 months there has been a cash inflow of 50,000 rupees. So NPV means the net present value is what we have to calculate, right? So for that we need to calculate the discounting factor, and the discounting factor, as you all know, is 1 divided by 1 plus the rate of return that you have. So I'm directly linking it from here, and then I'm pressing F4 because I want to freeze this thing, because I don't want this box to go down. That is why I want to freeze it, and then I will close this bracket to the power of the value over here. Since it is the initial, since it is initially, so it will come out to be 0. Then for the first month it will be 1, for the second month it will be 2. So I have written 0, 1, 2, 3 over here intentionally, just to make sure that I can relate this formula directly from here, so that I don't need to type these 1, 2, 3, 4 again and again over here. So if I press enter, I get a discount factor of 1. And then I don't need to do anything. I just have to, this plus sign comes, and this plus sign comes, you just double click on this. And if you double click on this, what it has done is that it has gone down, it has copied the formula, and has changed the required the values here. So if you see here, it is the same 1 plus 1 plus 1% interest to the power of B7 it has taken now. B7, that is 1. Now similarly, this has taken B8, that is 2. So it becomes very easier for me, right? I don't need to type that 1, 2, 3, 4 again and again. If I write 0, 1, 2, 3 over here, I can directly link it to that. Now present value is nothing but the cash flow that you have in that particular month into the discount factor. So for the initial month it will be the same thing, because it is actually the present. And then again, once this plus sign comes, you just have to double click here. Once you double click here, they calculate the multiplication of, if you see here, it has calculated the multiplication of 50,000 with 0.990, and similarly it has happened in this case as well, and similarly write down. So we got the present value of all the cash flows which was happening in the initial month. It was a cash outflow. In all the other month it was a cash inflow. That is why they have been denoted as positive. But we got the present value of all the cash flows which are there. And NPV is nothing but it is the sum of all the cash flows which are there. So we will just sum it up, and once we sum it up, we get the NPV value as 3,19,753.87 rupees. And this NPV is greater than 0, right? This NPV is greater than 0, and since it's an independent project, so this project should be accepted. Since NPV is greater than 0, that is why this project should be accepted. Now let us see another example based on the NPV technique. So here the question goes like, an initial investment of 83,20,000 on plant and machinery is expected to reduce the labor cost by 34,11,000 and 40,70,000, 58,24,000, 20,65,000 respectively for first, second, third and fourth year. So basically you have done an investment, and it's actually leading to cost savings in the subsequent years, that is in the first, second and third and fourth year. At the end of the fourth year, the salvage value is 9 lakh. 9 lakh rupees is the salvage value, means the plant and machinery which you purchased on 83 lakhs, at the end of 4 years, its value just remains 9 lakh rupees. So if you sell it now, you are going to get 9 lakh rupees from the market. Now what they're asking is, they're asking us to calculate NPV if the discount rate, that is ROR, rate of return, that is weighted average cost of capital, all the names are same, is given as 18%. So 18%, so I have written R as 18% over here. and now I have to calculate. So what I've done is that in the initial year, there has been an investment, so I've denoted with a negative sign minus 83 lakh 20,000, and then for year 1 2 3 4 I've written down the cash inflows which have occurred, right? So now I have to calculate the discount factor in order to find out uh, the present value. So the discount factor will be 1 divided by 1 plus this interest, and I will actually freeze this because I don't want this particular cell to change. Close the bracket. To the power of, I will link it with here so that I don't need to write it manually from here 1 2 3 4 etc. So we'll get the discount factor as 1, and similarly once this plus sign comes, just double click over here and you will get the discount factor for year 1 2 3 and 4 as well. And present value is nothing but the cash flow that you have multiplied with the discount factor. And again, once the plus sign comes, just double click on that and you get all the present values. So NPV should be equals to sum of all the present values. But yes, we are forgetting out on something over here, is that we have not considered salvage value. So salvage value, we'll look at it separately. So if you see the salvage value, this means that it's going to occur in year 4, and if you are selling it, obviously you are going to get cash, so it's going to be a cash inflow of 9 lakh, and your discount factor will be equals to this much itself. Why? Because it's at the 4th year, so your discount factor will be same as this, and then you can easily calculate the present value, that will be equals to 9 lakh multiplied with the discount factor that you have, that is 4,64,000 something. Now you can calculate the NPV. NPV will be the sum of all these present value along with, so I'll just do it again, NPV will be the sum of all these values along with your salvage value. Press enter, and this is 2,56,000 becomes your, it is actually 25 lakhs, right? 25 lakhs, this is what actually becomes your salvage value. So sorry, it becomes your NPV. So this is how we calculate the NPV. So here a special care should be taken on seeing that there is a salvage value attached as well. So you have to convert this salvage value, and salvage value is always positive because if you're selling something out, obviously you'll get a cash inflow, so that will be considered as positive, but you have to convert into its present value, and so you have to multiply this thing with the discounting factor to get the present value. And once you sum all these things, you will get an NPV. So you'll get an NPV if you do a sum of all these things. So I hope this example was able to clarify the NPV concept to you. And since this NPV is positive, so obviously this NPV is positive, so we know that if it is an independent project, the project should be accepted. Please revise these examples again and again so that you are clear with the NPV concept.
Well done, guys. You have successfully completed 3 most important techniques in capital budgeting. You did payback period method, you did discounted payback period method, and now you have completed the NPV technique of capital budgeting. You have been doing fabulous. Your sincerity will bring you a lot of laurel. And now I am very much eager to take you to the 4th technique of capital budgeting. And that technique is known as IRR method. That is internal rate of return method. Very much connected with NPV, although the metrics that we are going to take is slightly different, but it's pretty much connected to the NPV method. Let us go and see what is this IRR method all about. And then we'll also take some examples, some live examples, to see how do we implement this IRR method and how is it different from the other techniques as well, and where can we actually apply this particular technique of capital budgeting.
So now we are going to study another method inside capital budgeting techniques, and that method is internal rate of return method. Internal rate of return method, again a very important method. Now, it is the discount rate at which NPV of an investment becomes zero. So as we already know that to calculate an NPV, we need to have a discount factor, also known as the rate of return, or WACC, that is the weighted average cost of capital, or rate of return, or discounting factor, anything you can call it. So at what discounting factor, you have to keep on changing the discounting factor, you have to keep on experimenting with the discounting factor, and on changing, you have to find out that particular discount rate or discounting factor or rate of return at which the NPV of the investment will become zero. And that discount rate will be known as IRR, that is internal rate of return. Internal rate of return. The decision rule says that the project is to be accepted if its IRR is not less than the target IRR. Means the IRR that you have got should be greater than or equals to the target IRR which is there. So if it is greater, then the project is to be accepted. That is in case of independent projects, but in case of mutually exclusive projects, the project with a higher IRR should be accepted. So if you have got two projects with IRR 1 and IRR 2, and if IRR 1 is greater than IRR 2, then one project should be accepted. That is in case of mutually exclusive projects. Now, as I already told you, IRR calculation is based on experimentation. Experimentation in the way like, you have to find out that particular discount rate at which the net present value will become zero or very, very close to zero, right? That becomes your IRR. So it's an experimental thing because you have to experiment with different values of discount rate. If you call this the discount rate as small r, this means that you have to experiment with different values of r, and then you have to see that particular value of r at which NPV becomes zero, and that r becomes your internal rate of return. Now, what does it mean actually? NPV becoming zero, what does it mean? This means that the net present value of all the cash flows becomes zero. Means the present value of all the cash inflows should be equals to the initial investment. Or you can also say it like present value of all the cash inflows is equals to present value of all the cash outflows. So the second seems to be more broad, in its definition. That is, the present value of all the cash inflows becomes equals to present value of all the cash outflows. And once that happens, the net NPV, that is NPV, becomes zero. So the discount rate at which NPV becomes zero will be called IRR. IRR is nothing but internal rate of return. Now, how to calculate IRR? We'll go step by step on how to calculate IRR. Now let us see. The first thing is what you have to do is that guess the value of R and calculate NPV using that R. So you guessed a value of the discount rate, that is small r, and then you went on to calculate the NPV using R. Now one case is that you got NPV to be zero, then that R becomes your IRR. It ends over here if the NPV is coming out to be zero. If the NPV is greater than zero, then you increase R and jump to the last step. And what is the last step? That is, you recalculate the value of NPV using the new R and then go back to the second step and check whether if it is zero or not. If it is not zero, then again follow the same process. Similarly, in the fourth step, if NPV is less than zero, you decrease the R and go to the last step. That is, you calculate the new NPV and then see whether if it is zero or not. If it is not zero, then again follow the same step. So keep on doing it, right? Unless or until you get a R at which NPV is equals to zero, and that R becomes your internal rate of return. Now the decision rule is if the cost of capital is less than IRR, means IRR is greater than the cost of capital, then the project is to be accepted. Cost of capital is what? If you remember, this is WACC. Right, this is WACC. If IRR is greater than WACC, that is cost of capital, then the project is to be accepted. This means that your project is going to give you greater returns as compared to if you'd have done your investment in some other means. That is what is called the cost of capital. So if your IRR is greater than the cost of capital, means the project is going to give you a higher return. So you have to accept the project as such. So guys, let us take an example to understand, how do we calculate IRR? As we know from the basic definition of IRR, is that it's the discount rate at which the NPV becomes zero, right? Now, so we have been given with a set of data that we have that in the beginning there's an investment of 2,13,000, so it is denoted with negative, and then in the consecutive years, like year 1, 2, 3, 4, we have got a cash inflow of 65,200, 96,000, 73,100, and 55,400. So these are all the cash inflows which are there. And now to calculate the NPV, we need to find out the present value, and for finding out the present value, we have to find out the discount factor. And that is why I've taken a column for R over here. So let me place this R to be 10%. So I'm placing this R to be 10% right now, just for the value sake. So if I have to find out the discount factor, that will be 1 divided by 1 plus this R. I will link it over here, and I will actually freeze it because I don't want this thing to change. And then I'll place to the power of, I will link it here so that I don't need to put in manual values like 0, 1, 2, 3, etc. I'll press enter, so I get a discount factor. And then similarly, once I get a plus sign, I will just double click on this, and this will calculate the discount factor all across. Now present value will be nothing but this will be the cash flow multiplied by the discount factor that I have. And then once this plus sign comes, double click, it will calculate the present value of all the cash flows. And for the definition's sake, we know that the NPV is nothing but the sum of present values of all the cash flows which are there. And then I can calculate this sum as, this will come out to be 18,371. And this is the NPV which is coming out at R equals to 10%. Right. So if I make R is equals to 11%, the NPV comes out to be 13,000. Seems to be decreasing, right? If I make it 12%, it comes out to be 8,983. If I make it 13%, comes out to be 4,521 now. So it's closing to zero now. If I place 14%, it is 203. So very close to zero. If I place 15%, oh, it got negative. This means that the NPV is between 14 and 15. So this is, and sorry, NPV, no. The IRR is going to be between 14 and 15%. Why? Because the NPV is getting zero between 14 to 15%. See, at 14% it is 203, and at 15% it becomes negative. This means that it's going to be between 14 to 15%. So let me put it 14.5. It gets negative again. So it's going to be between 14 to 14.5 for sure. If I put 14.2, it's again negative, means it's going to be between 14 to 14.2. If I place 14.15, it's again negative. 14.1, it's again negative, means the IRR is between 14 to 14.1. This is how close I can get it, with the help of experimenting out. You don't need to find out an exact value, but you reach as close as possible. So since we know that it's going to be between 14 to 14.1, let us put this value as 14.005, let us suppose, or maybe 14.05. So it's -8. So it's very close over here. So one thing, I'm again sure that it's going to lie between 14 to 14.05. So I'm getting closer. See, if I make it 14.02, it gets positive. So 14.03, it gets 76. So 14.05, it was -8. So it's somewhere going to be between 14 to 14.05, and we can call this to be our IRR, right? Somewhere between 14 to 14.05, right? So this is how we can actually calculate the IRR, just by experimenting, by changing the value of R, and just finding out where is the NPV becoming very close to zero, and that becomes our IRR actually. Now there is another method, just again to find out an approximate value, like was here we reached, like the IRR will be lying between 14 to 14.05. Similarly, we can also adopt this method as well to find out an approximate value. So I'll just tell you, how to find out this. Let us suppose, okay, I will find out a value at 10%, and then I will, now why I'm doing this thing, hash over here is that because I want it to show at, just as 20%. I don't want it to be kind of a value for percent. I just want to show it as a, just as a thing for, 10%, 20% or something like that. So I want to find out NPV at these two values. So let me put R as 10% and the NPV comes out to be this thing. So it comes, sorry, let me do that again. So NPV is nothing but sum of all these present values, bracket closed, and this is there. So NPV at 10% is, for me, is 18371.62762. Oh, this is the NPV at 10%. So let me find out the NPV at 20% as well. So this comes out to be minus of 22979.93827. Now, since I know that, NPV at 10% is positive and NPV at 20% is negative, this means that the IRR is going to lie between 10% to 20%. This is, a rough range that I got. But I don't want to experiment with so many numbers, right? Likewise, in this case, VD is pretty close, right? 14 to 14.05%, pretty close. So if I calculate it for 10% and 20%, can I find out, in nearby IRR? Yes, we can do that. So IRR, if you have to calculate, that will, you have to find a value, like, you have to find out, see how I do it. So what I'm going to do is that I'm going to take a whole bracket and then I'm going to do NPV at 10% multiplied by 20% minus 10%, right? So NPV at 10% multiplied by 10% minus 20% minus 10% divided by, again a bracket, NPV at 10% minus NPV at 20%. And now the bracket is closed. So if I find out, it comes out to be, 0.044 something, but in terms of percentage, I will just multiply it with 100. So this comes out to be 4.42%. So IRR will be equals to 10, that is 10, since we took 10 as a reference, plus this value that we have calculated. So it will be somewhere close to 14.42. And if you see this number, it's very much close, although not that much close, but yes, it's pretty close, right? So this is how, you can calculate an approximate value of IRR as well. So what we did is that, we took 10% as a reference and we found out, the value of NPV to be that, like that. And then we also found out value of NPV at 20%. And what we found out is that one is positive, other one is negative, means the IRR is going to lie between the two. So we took 10 as a reference and we calculated this thing. So what we did is that NPV at 10% into 20%, the other reference minus the first reference, divided by the NPV at 10% minus NPV at 20%, and this gave me 4.42%. And then I added that with 10% to get 14.442%, right? So this will give me an approximate value of IRR. So this is how, you can calculate your IRR, and it becomes pretty easy, it seems. Please do revise this question again and again and try to calculate IRR. It will become very easy for you as well. Now let us see this question again on the basis of, IRR calculation. And we know that, if IRR is greater than the cost of capital, the project should be accepted. And this is what we have studied. So this example is based on that itself. So what it says is that a company is considering investing 2,50,000 rupees in a business. The cost of capital for investment is 13%. Calculate IRR and interpret your answer. So this is what the cash flow that we have got, for initially there has been an investment. So it's a negative cash flow of, minus 2,50,000. Then from year one, there has been cash inflow of 50,000, 1 lakh, 2 lakh in year one, year two, year three, respectively. But to calculate the NPV, now in order to find out the IRR, it means, we have to find out, the discount rate at which NPV gets 0. So that is why we have placed a value of R over here. Let us take a random value to be, 10%, let us suppose. So we took a random value now to be 10%. And remember, once you're placing it in percent, always put this thing in percentages. Otherwise, it will show you, in decimal format. So 10% is the rate that I've taken, kind of random value. And then I will be taking the discount factor, and this will be nothing but 1 divided by bracket 1 plus, and R, I will freeze this up because I don't want, this thing to change, bracket closed, to the power of, we'll link it to here so that I don't need to put it again and again manually, and the discount factor will come to be 1. Again, once the plus sign comes, I will double click, we'll calculate the discount factor for each and every cash flow. Present value will be the cash flow multiplied with discount factor. Again, I will, plus it from here, and it will calculate the present value for all the cash flows. Now NPV is the sum of all the present values of all the cash flows, so we'll just take the sum of it, and this is coming out to be 28,362 at, if you are taking the discount rate at 10%. If I make this discount rate as 12%, it decreases. So if I make it 13%, it decreases further, means I'm going in the right direction. If I make it 14%, it decreases further. If I make it 15%, it is 595, decreases. If I made it 16%, it becomes negative, means that it's going to lie between 15% and 16% for sure. Means IRR is going to lie between 15% to 16% for sure, right? So this is, this is the range in which it is going to lie, and the cost of capital is 13%. So the IRR is obviously going to be more than 13%, right? So this is for sure that IRR is going to be greater than 13%, right? So this project, this investment has to be accepted. Investment has to be accepted. Right, so in many cases you don't need to require to find out an exact value of IRR. Once you get it, like it is going to be between 15 to 16%, you can directly tell that it's greater than the cost of capital. So obviously, the investment can be accepted in this case. Now let us, analyze the last topic inside this capital budgeting course, is that what is the impact of income tax on capital budgeting decisions? Yes, income tax do have huge impact while you are, deciding on any project. So an investment that looks desirable without considering income tax, IT's income tax, may become unacceptable after considering income tax. So it can create a huge difference, right? While you start considering income tax inside, all the calculations that you have done. But till now, we have not considered income tax. If you remember, we have never taken income tax into consideration. But now we'll be taking some example, where I will show you how income tax affects, the entire calculation. So there will be three terms which will be involved, which we'll cover with the help of an example, is the after-tax benefit, or also known as the after-tax cash flow, after-tax cost, and the depreciation tax shield. So these are the terms. These are the after-tax benefit or after-tax cash inflow, after-tax cost, and depreciation tax shield. These are the three terms which we'll understand with the help of an example, and we'll also see that how income tax have an impact on capital budgeting decisions. Now in this example, we will see, what is the effect of income tax on the calculation part. So let us see this with the help of an example. So the company purchased an equipment to save cost, and the cost of the equipment, that is the initial investment, is 2,40,000 rupees. Expected cost savings that is provided by the equipment is 1 lakh per year. Means this is the savings that the cost that the equipment is going to provide. Means it's going to be a cash inflow, right? Because savings is what? It's kind of a thing that I'm getting, right? So it will be cash inflow. Useful life of the equipment is 6 years, and the salvage value is taken to be 30,000. Means at the end of 6 years, the value of the equipment will be 30,000. Tax rate is to be taken as 40%, and the discount rate is to be taken as 12%. Now in this case also, we are going to take a single line method for depreciation. And one more thing over here is that while calculating depreciation, we are not going to take salvage value into consideration. Consider this to be written inside the question as well. So see here, it's given that it is depreciation by straight line method, and salvage value is not considered for computing depreciation. So if I have to calculate the total depreciation, that is going to be 2,40,000 rupees, right? Because we are not considering salvage value. And if I have to calculate it annually, since it is 6 years, so they are going to be 6 periods. So this is 2,40,000 divided by 6. So that comes out to be 40,000 depreciation. That is going to be the annual depreciation that is there, right? Now, we'll talk about the annual savings. So annual savings is going to be 1 lakh rupees. So that is going to be valid from beginning till from 0 to 6 years. And that cash flow is what? 1 lakh rupees, right? And it's a cash inflow since it's a saving. Now tax. So since it's a savings, right? So and there will be tax applicable on that. And what is the percentage of that tax? Is 40%. So means you're going to get only 60%, right? So because 40% of the part is what you're going to give out as tax, so the remaining thing with you will be only 0.6. So what will be after tax cash flow? After tax cash flow will be nothing but 1 lakh multiplied with 0.6. That comes out to be 60,000, right? Now, so 60,000 is your after tax cash flow every year. Every year this is going to be your after tax cash flow, means at the end of first year, second year, third year, fourth year, fifth year and sixth year, right? But you have to find out the present value, the net present value of all the annual savings which is there. Like for all the 6 years, you have to find out the net present value. Now one thing is that what you can do is that you can write this 60,000 for 6 times, calculate the discount factor for each of the 6 periods, and then calculate the present value and then add it. There is one another technique which is there, is that let us calculate the discount factor over here. So discount factor will be what? 1 divided by 1 plus. Now what is the discount rate that is to be taken? So let us first of all place the discount rate over here. Let us suppose I have taken the discount rate, I have written it over here to be 12%, and since it shows at 0.12, so I will just click on that cell and will click on this percentage, so it will start showing as percent. Now I will calculate the discount factor. So the discount factor will be 1 divided by 1 plus r, and want to fix this r because I don't want this value to change. Close this bracket, to the power of, I will link it to this, that is because I don't want to place 1 2 3 4 5 6 individually, so I will link it directly to this. We'll click it and this will give me the discount factor for some cash flow which is at the end of 1 year. As soon as the plus sign comes, I will just double click on it and this will give me the cash flow for different periods. So for some cash flow which is in the 6th year, if we want to convert it to the beginning, I have to multiply it with this discounting factor. So can I say that 60,000 will be in the 6th year, 60,000 will be in the 5th year, 60,000. So if you multiply it, this will be something like 60,000 multiplied by this factor plus 60,000 multiplied by this factor. If you take 60,000 as common, this means that this will be the sum of this multiplied with 60,000. So can I say the total of it will be sum of this? So sum of this comes out to be 4.11, and if I multiply this discount factor with 60,000, I will get the net present value of all the 60,000 which is there across all these 6 years, right? So I can write discount factor to be directly as this, and I will freeze it because I don't want it to change. So, and then I will again convert that into general, let us suppose a number, and then so the present value will be 60,000 multiplied with discount factor, so that comes out to be 2,46,684. And remember, this is the present value, not for 1 year, this is the present value for the entire 6 years, right? So this is how I can calculate the present value, and I have taken only that cash flow which comes after tax, and I have deducted a tax of 40% over here from the cash flow which is coming, that is 1 lakh. Now the second thing is the depreciation tax shield. Now what do you mean by depreciation tax shield? Is that, see, if you see this 1 lakh, it is the savings, right? But it is not the net savings, and tax is always applicable on the next net savings. Tax is applicable on the profits that you generate. So ideally you should have subtracted this depreciation from this savings, and then you would have applied the tax. So what you have done is that, so you have got a depreciation. What is the depreciation, annual depreciation you've got? You have got 40,000. So you have ended up subtracting 0.4 of 40,000 from this 1 lakh, which should not have been subtracted, right? So I will take here the tax effect to be 0.4, and this will come out to be 40,000 multiplied. So this will come out to be 40,000 multiplied by 0.4, and this will come out to be 16,000. And this 16,000 is for the all, all the period. So I will again link it with this, and will again, change it to general, and I can find out the present value come out to be 16,000 multiplied with discount factor. So that comes out to be 65,782 rupees 0.51. Look at it in this way as well, right? So what is going to happen is that you have got a lakh rupees of savings, but you're not going to pay tax on this, right? You're going to pay tax on what? You're going to pay tax on 1 lakh minus 40,000. That is 60,000 is the money on which you're going to pay tax, because 60,000 is your net profit or net savings that you have. And what will be the tax on this 60,000? That will be 0.4 multiplied by 60,000. So that will be 0.4 multiplied by 60,000. So you're going to pay a tax of 24,000 only. So if you pay a tax of 24,000 on 1 lakh rupees, this means that this is 76,000 is the the cash that you will have after paying the taxes. So 76,000 is the cash that you will have after paying the taxes. So, and what is the discount factor that is there? That is 4.11. So if you multiply this 76,000 with the discount factor that you have, you get 3,12,000, and the same value you will get over here as well. If you do the sum of both these present values, you will get the same value. See, 312,467. So this is how we can understand. So depreciation shield means, on 40,000 you have paid taxes over here, right? Which you should not have actually paid. So we are adding it to your present value because it has been deducted from here. So that is why we are adding it to your exact present value. So this is how you can actually understand it. Right now, talking about the residual value. So residual value will be only at the end of 6th year. And what is that residual value? It is 30,000. Right? It is 30,000, and what will be the after tax value for that? That will be equals to 30,000 multiplied with 0.6. Right? And what will be the discounting factor that you will take? You will take the discounting factor for the 6th year only. Why? Because this salvage value, this residual value is only for the last year. So you'll take a discounting factor of this, and again you'll convert it to general, right, or maybe number, right, and let us take it up to 4 digits, and you can find out the present value by just multiplying the cash flow with the discount factor, and that will come out to be 9,119. Now the last column is the equipment cost. Equipment cost, it happened in the initial part as well, and this is going to be minus 2,40,000. And you don't pay any tax on that, right? So your even after tax cash flow will be minus 2,40,000, right? Why you are not paying? Because it's a kind of an investment which is being done in the beginning, so you don't pay tax on investment, right? You pay tax only when returns start coming. For this, the discounting factor will be 1 since it is at the beginning itself. So the present value will be equals to this part. So if I have to calculate the NPV will be nothing but the sum of all these present values, and that comes out to be 81,586 rupees. So NPV is coming out to be positive. So see, how does it actually, it actually made a huge difference. So it actually made a huge difference, right? Once you are calculating, once you are taking the tax part into consideration. Vis-a-vis, if you would have not taken tax into consideration, right, things would have been a little bit.
That's great. You have already completed almost the entire course on capital budgeting. You are ready to go, guys, and you are ready to contribute to your existing organization or to your coming organization in a better way. You have opened a lot of opportunities for yourself. Because if you know capital budgeting techniques well, which you now know, you open up a lot of opportunities for yourself inside the industry. Because every industry, every company uses capital budgeting techniques in one way or the other. Today, we are going to talk about the last technique, but not the least one. It's known as the ARR method. That is the accounting rate of return method. This is the last one. And let us deep dive into what is this technique all about. And then we will also see some examples to see how to apply ARR technique in details. And I'm going to see you just after this, because I'm going to talk about what importance this entire course will play in your life and how should we, move forward once you have completed this entire course. Stay tuned, guys.
Now let us see another method as far as capital budgeting technique goes, and this method is called accounting rate of return method, ARR method, accounting rate of return. Now, what is it? What is accounting rate of return? It is the ratio of the estimated accounting profit of a project to the average investment made in the project. So it is the ratio of estimated accounting profit. There are two terms, estimated accounting profit and average investment made in the project. Now, this estimated accounting profit is an average profit. Remember this thing. This is an average profit. Means that if you have got first year, second year, third year, fourth year, if you have got X, Y, Z, W, accounting profit in different years. So what you have to do is that X plus Y plus Z plus W divided by 4 will be your this thing, estimated accounting profit. So estimated accounting profit is an average profit that we are talking about to the average investment made, right? And what is average investment? Average investment is the sum of the beginning and the end book value of the project divided by 2. So average investment is sum of the beginning and the end book value, means beginning end book value plus end book value divided by 2. That will be called the average investment. An average accounting profit, as I told, is the arithmetic mean of the accounting income to be earned during each year of the project's lifetime. That is the average part. And what is ARR? ARR is the ratio. ARR is the ratio of average accounting profit divided by average investment. So this is how you should have an understanding of each of the terms. This will become very clear once we take some examples based on it. But ARR is what? Average accounting profit by average investment. Average investment is your initial book value plus final book value of the project divided by 2. And average accounting profit is this is what I explained it over here, is that incomes for different years and then you take an average of it. That will come out to be your average accounting profit, right? So this is how you can define the ARR. Now ARR method, what is the decision rule? Accept project only if ARR is greater than the required accounting rate of return. So whatever accounting rate of return is required, means it's given inside the project that this you should have at least this much ARR. If your ARR which you have calculated is greater than that, then accept the project, otherwise reject the project. In case of mutually exclusive project, accept the one with a higher ARR. So this is to in case of independent project, like a greater ARR project will be accepted, but in case of mutually exclusive project, you have to accept that with a higher ARR, right? Higher ARR. So in case of independent project, what will happen is that you will be given a project, you will calculate the ARR, and if this ARR is greater than the ARR required given over there, you accept the project. But in case of mutually exclusive project, you compare both the ARRs or all the ARRs calculated for different mutually exclusive projects, and then whichever is having a higher ARR, you will actually end up accepting that project. Now, one drawback of ARR method is that it ignores the time value of money. So the time value of money is not taken into account, right? And this is a very big drawback, because time value makes a lot of difference. So it ignores the time value of money. This is one of the disadvantages of ARR method. Now let us take an example to understand the ARR method. That is accounting rate of return method. So in this example, it's given that there's an initial investment of 1,30,000 rupees is expected to generate an annual cash inflow of 32,000 for 6 years. Depreciation is allowed on a single line basis. We'll see what is this. Scrap value of that investment, maybe you would have done an investment to buy an equipment. So the scrap value is taken to be, means the value at the end of 6 years is taken to be 10,500. So you have to calculate the ARR assuming that there are no expenses on the project. So there are no other expenses except the given here. So we have been given an initial investment of 1,30,000, which is there. And then we have also been given a scrap value. Now, can we calculate depreciation expenses per year? Yes, we can calculate it over here. So see, if I have to calculate the depreciation, the overall depreciation will be given by what is the value of that equipment, on what investment it was bought, minus the scrap value of it. That is the total depreciation that I will have. And this entire depreciation is spread over a period of 6 years. So can I say that if I have to find out an annual value, this will be nothing but this total depreciation divided by 6. So for me, the annual depreciation will be 19,916 rupees 67 paisa. So this is what I will write it over here, that the depreciation per year is this. I will link it to this cell. Right? So this is depreciation expense per year. Now annual cash inflow as it's given inside the question is 32,000. Right? So 32,000 is the cash inflow which is coming, and depreciation is a kind of a thing, which you are losing out. So it's kind of a cash outflow, right? Because the value of machine is decreasing, right? So you're losing out on cash. So depreciation is a negative expense, right? Because something is going out and it's a non-cash expense. So something is going out, so it's an outflow. So if you have to calculate profit, so what you will do is that whatever expense, whatever cash is coming to you, that is 32,000 minus the depreciation expense which you have there. So the net profit comes out to be 12,083 rupees 833 paisa. So this is the annual accounting profit, and this is what we actually wanted, because annual accounting profit is nothing but average accounting profit, which we wanted as a numerator. So we have got the numerator for calculating, for calculating ARR. Now average investment is the initial book value plus end book value divided by 2. Now in this case, since we don't have exact data of the book value, so what we assume in these all cases is we assume the initial investment to be equals to the average investment. So that comes out to be 1,30,000. So ARR is nothing but the annual accounting profit that you have divided by 1,30,000. So that comes out to be 9.295%. So ARR in this case is coming out to be 9.295%. So in this way you can calculate the ARR. Now if you see depreciation, what we have done is that we have what we have done is that we have done initial value minus final value and then divided by 6. And this is what is known as a straight line method. So a straight line method means depreciation is equally spaced out across all periods, and this is what we have done. We have spaced out this depreciation of 1,19,500 rupees across all the 6 periods, and that comes out to be 19,916 rupees 67 paisa. So this is how we can calculate the ARR from here. Now let us see another example where we are again going to calculate the ARR value over here, and so we are going to calculate the ARR value over here. So if you see here, what we have been given with 2 projects, project A and project B. So we have been given with 2 projects, projects A and project B. And for both the projects, right from the starting, that is 0th year, 1st year, 2nd year, 3rd year, and for B project also, it goes on till the 3rd year. Now for project A, there is a cash outflow of 220. Now all the numbers are in thousands, right? So all the numbers are in thousands. So this is what you have to remember. So cash outflow means there will be some investment that was done in the beginning. So that is why there is a cash outflow of minus 220 at the 0th year, means in the beginning. Similarly, that is for project B, there is a cash outflow of 198,000. cash inflow in the beginning is 0, then in the at the end of first year it is 91, in the end of second year it is 130, and in the end of third year it is 105. And same is the case with project B. We have been given with cash inflows at the end of first year, second year, and third year. Then we have been given the salvage value. Salvage value, this investment that you did of 220 was, used for buying some equipment maybe. So at the end of third year, the salvage value of it comes out to be 10. And in case of project B, the salvage value comes out to be 18. Right? Now, how can I calculate depreciation for project A as well as project B? And we have to use single line method of depreciation, let us suppose. So single line method of depreciation, what you will do is that if you have to find out depreciation, right, how will you, so at the end of first year, right, at the end of first year, right, how will you find out depreciation? Let us, see over here, if we have to see for project A, and then I will do it similarly for project B. So for project A, the total depreciation, if you talk about, is what? Is the initial value, that is 220, minus the salvage value, that is 10. So 210 is the total depreciation. Similarly for project B, what is the total depreciation? 198 minus 18, 180. Now annual depreciation, can we find out? 210 is distributed over how many periods? See, from 0 to 1 there is one period, from 1 to 2 there is second period, from 2 to 3 there is third period. So there are total 3 periods. So divide by 3, that will give you an annual depreciation of 70. Similarly, if you divide 180 by 3, you will get an annual depreciation of 60. So this is the same thing which will be written over here. That will be 70, and in this case it will be 60. And the same will be copied all across, because 70 and 60 is going to be depreciation across all the, at the end of first year, at the end of second year, at the end of third year. Right? So this is how we calculated the depreciation. Now average profit. Now can we calculate profit? Yes, we can calculate. So at the end of first year, can I say that cash inflow was 91? Depreciation is an expense because you are losing out on, so it's a cash outflow. So I will minus depreciation. So for me, the profit at the end of first year will be 21. At the end of second year, the profit will be, for second year, the profit will be 130 minus 70. That comes out to be 60. And for the third year, the profit will be 105 minus 70. But then there is a salvage value also. So salvage value means if you sell it, what is the value that you will get? So it's a cash inflow kind of a thing. So we'll do plus 10. So this will become the profit, right? Similarly for here, I can calculate the profit as 87 minus the depreciation that is there. So if I just copy paste the formula, I can just find out the profits for different period, except in this case I have to add the salvage value as well. Right, so this will become the profit. Now this is the profit. So this is not average profit, this is the profit annually, right? But what I need is that I need an average one, right? I need an average one. So average profit for me will be equals to, can I say, it will be the sum of all these three divided by 3. So that will come out to be 42. So 42 becomes my average profit, right? Average investment will be 220, which is equals to the initial book value, end book value divided by 2. But we don't have the entire the exact data with us about the book value. So we will in these cases we use the initial investment to be the average investment as well. So in this case we can calculate ARR to be 42 divided by 220, and I can write this as percentage. So this comes out to be 19%. Now similarly in this case I can calculate average profit as sum of all these profits which are there divided by 3. Now average investment in this case will be 198. So ARR can be found out to be average profit which is there divided by average investment So if I convert that into percentage, this will come out to be 20%. Let us take, up to 2 digits, maybe up to 3 digits, maybe. Similarly, I can take it up to 3 digits as well. So this is how I can calculate the ARR for both the projects. So which project should be selected? If they are mutually exclusive projects, right? So, the project B should be selected because it's having a higher ARR. Means the returns are more, right? So basically you're talking about the returns are more. That is why you are going to select project B from here. So I hope these examples would be able to, clarify your concepts very well. Please do revise these examples again and again so as to be clear about what is ARR method all about.
You have completed the IRR method as well. You have done some examples on that as well. And now we are going to talk complete business. We are going to study a technique which is known as the profitability index method. What does it say? The amount of money that I have invested, am I going to get a return which I'm expecting? And this entire thing comprises the next technique that we are going to study in capital budgeting, and that is the profitability index method. That is the profitability index technique. It's basically a cost benefit analysis that we are going to do. Let us see what is this technique all about, and we are also going to solve some live examples which is going to illustrate how to apply profitability index technique of capital budgeting to solve real life capital budgeting problems.
Now we are going to study another method in the as part of the capital budgeting technique. So that method is known as the profitability index method. It's a very simple method. So what we are going to do is that for each of the project, we are going to find out the profitability index. Now, what do you mean by profitability index? That is equals to present value of all the future cash flows divided by initial investment. Initial investment means at the 0th year, whatever investment that, let us suppose you made an investment of A, means it is a cash outflow. Since you have made an investment of A, means A is a cash outflow. So that will be known as the initial investment. And then, at the end of first year, second year, third year, fourth year, whatever cash flows are happening, let us suppose X, Y, Z, and W, all these are known as the future cash flows. So you have to take the present value of all these future cash flows, you have to sum it, and then you have to divide it by A, and that will give you the profitability index for that particular project. So in this way, we'll calculate the profitability index for the project which you are actually planning to undertake. And the decision rule is, if the profitability index is greater than 1, you accept the project. And if the profitability index is equals to 1, you stay indifferent. If the profitability index is less than 1, do not accept the project. Now, it is also used in another way. It is also used as an appraisal technique as well. So what happens in case of appraisal technique is that, let us suppose your project is going to last for 6 years. Your project is going to last for 6 years, and you had some initial investment at the 0th year. Right, and at the end of first year, at the end of second year, let us suppose, what you found out is that, the way it's actually going ahead, you have your cash flows. Let us suppose, at the end of first year, you have got X, you have got Y, but then, at the end of second year, you wanted to analyze, whether the project is going in the right direction or not, means the project is going to remain profitable or not. So what you did is that you extrapolated this Y all across, the 6 years, and you calculated the profitability index, and the index was coming out to be less than 1. Or maybe the index is coming out to be 1, or maybe the index is coming out to be greater than 1. So, at that point of time, you can take a decision whether to continue on with the project or not. Because if you continue on with the project, ignoring the fact that profitability index is coming out to be less than 1 at a particular time, that is after 2 years, you may end up incurring huge losses, because at the end of 6 years, you cannot recover the entire capital asset. But at least at the end of second year, you will lose capital, whatever you have invested in, for year 1 and year 2. So it's also used as an appraisal technique to make sure that, whether your project is going in the right direction or not. So that is also one of the use of using, profitability index method. Now, it is also called the benefit cost ratio. So it's also called the benefit cost ratio, because since, what you are doing is that you're calculating the present value of all the future cash flows, right? So this is kind of your benefit, right? and you are dividing it with the investment. This is kind of a cost that you have incurred. So you're basically finding out the ratio of the benefit and the cost. And if it is greater than 1, you're accepting the project. So it seems to be very much logical that, you are finding out, your returns divided by the investment that you've got, right? And that is why it is also known as the benefit cost ratio. It is also used in capital rationing. This, since it helps in ranking the projects based upon their per rupee return. So what is this? This numerator, as we already discussed, this is nothing but the returns that you are calculating divided by the investment that you have made. Means you are calculating the returns per unit, return per unit investment, right? Per unit investment, maybe, per rupee or per dollar, anything, right? Depending on in which currency are you calculating. So basically you're calculating return per unit investment, and on the basis of return per unit investment you can actually rank the projects which are having a higher profitability index or a higher return per unit investment, will be obviously preferred as compared to the projects which are having a lesser profitability index or lesser return per unit of investment. So we will understand this concept with the help of an example. Let us see. Now we are going to take a question to make you understand, profitability index. So what we have got is over there is that company X is considering 5 different investment opportunities. Means company X has got 5 different projects to invest on. They are project 1, project 2, project 3, and project 4 and project 5. Present values are calculated using 10% discount rate. Company is unable to accept all the available projects because the funds available for investment are limited. So they have to decide on which project to invest on. And for all these projects, what are being given to us is the investment requirement and the present value of all the cash inflows. So all these cash inflows are going to be, kind of a projected values of cash inflows. And you have to take the present value, the summation of present values of all these, subsequent cash inflows which will come up. And then the investment required is actually in the beginning is this for different projects, right? Project life and then IRR is also given to us. And now how do we calculate profitability index? So profitability index is nothing but PV of all the cash inflows, that is divided by, I will take a minus sign over here because what I've done is that I want to make this investment positive, right? Since it's a cash outflow, so I've taken it negative, but inside the formula I have to take it as a positive. So it means that I want to take a mod of it. So divide by the investment required, and this will give me the profitability index. So once this plus sign comes, just extend this all across the projects, and this will give you the profitability index for all the 5 projects. So how can I rank these projects? So if I have to rank these projects, right? So I think that I should give the first rank to this project because this is having the maximum profitability index. The second rank will be given to this project. This will be the third rank project, fourth rank, and fifth rank, right? So if I have to select, 2 projects out of it, obviously I will go with first and second. If I have to select only one, I will go with this project 3. And if I have to go with 3 projects, I'll go with 1, 2, 3. So this is how we can rank different projects on the basis of the profitability index that is calculated. Profitability index is, the present value of all the cash inflows that will come in the subsequent years divided by the investment required that is in the beginning itself. So on the basis of that, we can rank different, different investment opportunities or different projects, and we can decide the projects on the basis of whatever, complete investment that we want to make. So this clarifies the concept of profitability index.
Congratulations, you have completed the course on capital budgeting. And now you know all the important techniques which are used inside the industry to solve capital budgeting problems. But I would advise you one thing. Keep on revising these concepts again and again. And stay tuned to this particular course space because every second week I'm going to post a question. And I'm going to post a solution 4 days after that. And you have to keep on solving those capital budgeting questions. This is just to make sure that you remain in touch with all the techniques that you have studied so far. Keep on revising these techniques, guys, because every knowledge gained sustains only if you keep on revising that. You have worked hard, and I truly salute the perseverance that you have shown over here by going through all those sessions. All the best, guys, and you deserve to get the best places inside the industry. Take care.